So we're just talking about it, inching towards 4,300. We're about 25 points away from it now. With that in mind, what is your WEX word of the day?
It's 20. And the reason it's 20 is because from the bottom in October of 3577 on the S&P to 4,300 is 20%. Now, that's psychological. Of course, number is just a number. But if we hit that level, I think it's a confirmation to investors that this is a rally that's not just a very short-term blip. It's 20%. That's meaningful. It's very meaningful to people who have been out of the market and haven't put their money back to work, who are really going to feel that they're missing something, that the economy has done better than expected. We are not in a recession. Inflation is coming down, and interest rates are close to peaking, despite there being some problems. But remember, the market was down 18% last year. So we're not even halfway back to where we were, because it takes longer and more to get back to even when you're coming up than when you're going down.
All right, so certainly something to watch. I think a lot of people are wondering if we're going to break through possibly today. Had a bit of a decline when it came to mega cap tech yesterday. So speaking of that, you sold some Apple about a week ago, and then you went into Microsoft. So just overall, do you think it's time to take profits from mega cap tech, or maybe shift how you're allocating when it comes to mega cap tech?
So it was a few weeks ago, but same story. We felt that at the multiple where Apple is now, it's 30+ times earnings, and the growth is not as robust as it was, of course. At its size, we thought we should take a little profits. Now, that was a mistake. In fact, the stock has gone higher. Microsoft, we think, has tremendous potential because not only is it the AI leader, and that's not the reason that we bought more, but it had been sluggish, and we just decided this was a time to add to Microsoft and take a little bit off Apple. Other than that, we have made no changes in the mega caps, and we own many of them. You know, we're a big owner of Alphabet, that's Google. We also own Meta, we own Salesforce, Apple, Amazon, too. So we are not out of this sector, but it's a diversified portfolio, and it's hard for anyone to be overweight those mega caps. Otherwise, it's half of your portfolio or your fund. And we really feel we need to see more participation, and we're beginning to see more participation in the market. Last week was the first time since March when all sectors of the S&P were up together.
All right, so can you give us some advice for our investors, especially today? Recently, we've seen the S&P outperform some of those mega cap tech names. Is this the time to be an index investor and just go into the SPY?
You know, it's an interesting question because the equal-weighted S&P has been so far behind the overall index. Up until a week ago, the S&P was up about 9%, and the equal weight, EW, SPX, EW, was only up 1%. Now we're starting to see some participation across other sectors, whether it's financials, which of course have been the worst performing sector in the market this year, but financials are starting to act better. We like Schwab, American Express, Blackstone. Some of the healthcare names are starting to do better, and not just large cap tech, but, you know, biotechs also.